This is not a presentation I do often. I also want to tell you why I want to do a presentation on Burton Malkiel. It is now probably something like 38 or 39 years since I've been reading on investment and finance. It's also 33 years since I have had a career in investment and finance. In these 33 years, if you ask me to name one single book or one single author who molded both my ideas in investment as well as my ideas in investment advising, it is Burton Malkiel. Before we start, let me summarize. Deepak in Simplest, I think, has got a baseline that appears everywhere in his website, in his literature, that an educated investor is an intelligent investor or a successful investor. My small contribution in education of investors. Let me point out to you that there are 3 books which can be considered as investment classics. At some point of time in an investor's life, it would be advisable to purchase and read and reread these 3 books. And right at the top of the list, probably, we will start with a book called A Random Walk Down Wall Street. By none other than Burton Malkiel. And equally important would be a book called The Intelligent Investor by Benjamin Graham. And the third, Common Sense on Mutual Funds by John C. Bogle. This, of course, is by Malkiel. You don't need to read anything more than this on investment. Let me also tell you that except this is the most difficult book to read. And this is the second most, perhaps. This is the easiest of the lot. Both on investment advising as well as on investing, there is nothing higher than this level of knowledge. So since this is one of the books that influenced me the most in a pretty long career now, into its 4th decade of investment advising, some of this knowledge can be presented even to general investors, investment advisors, as well as those aspiring to become investment advisors. So with this background, let's get into not this book, but a much simpler version of this book called The Random Walk Guide to Investing: 10 Rules for Financial Success. Who is Burton Malkiel? He is the Chemical Bank Chairman's Professor of Economics, Princeton University. He heads the Department of Economics at Princeton University. He is above 80 years, still teaching. For 26 years, he sat on the board of directors of Vanguard Group of companies, one of the largest mutual funds in the world, one of the top 5 largest financial entities in the world. To give you an idea of just how large Vanguard is, today Vanguard manages, that's as of last month, 4.8 trillion US dollars, 4.8 trillion US dollars of assets under management, and that would translate to about 307 lakh crores. If you want to know a comparative figure, the total size of the Indian mutual fund industry is 22 lakh crores. So you get this, one fund, one group, one investment group at that level, and the total, all the 44 or 45 mutual funds put together in India, you can see the contrast. So you know what Vanguard is and how big it is. And Burton Malkiel for 26 years, because he and John Bogle, who founded Vanguard, were friends, and they have sat on the board of directors for 26 years. In 1973, his bestseller, A Random Walk Down Wall Street, was published for the first time. And now we are in its 11th edition. I think 2013 was the 11th edition of A Random Walk Down Wall Street. This is the book I'm referring to. This is the investment classic. This edition was in 2013. In 2002, Malkiel wrote a simpler version of his earlier book and called it The Random Walk Guide to Investing, 10 Rules for Financial Success. So this presentation is based on this book. This presentation is based, it's a simpler version of the older one. And this is what it looks like. This is the book that's part of this, the main basis for this presentation. What I have done is, I've updated a little bit. I have also amended it, or changed it to meet or address the Indian situation where required. This is the classic. This is the one that I would encourage everybody at some point of time to read. Now let's say, look at the book a little more in detail. The simpler version was supposed to be for new and non-financial investors. It was mainly written for people who don't want mathematics, algebra, complications. But even this book, that's the simpler version of the book, has become a basic guide for all investors, because the areas it covers go beyond investment into financial planning and asset allocation. It's a very useful guide, and the beauty of it is it's about 175 to 180 pages, written in a very conversational style. What does Burton Malkiel say about the book and why he wrote it? Academics love to communicate. I know a few other people also who love to communicate. Some even like to practice what they preach. I do my practicing by sitting on the investment committees of some large institutional investors controlling hundreds of billions of dollars of assets. My preaching, I found, was too often restricted to my peers. What he says is that when his initial communication was mainly to other professors in the finance industry, to postdoctoral students and doctoral students, in short, to finance people. This is what he said. What was missing was trying to address the general public, the normal investors. I think it is important and useful for academics to write also for a broader audience, particularly on subjects of interest to the general public. The important thing is to write for the general public in a non-academic manner, in a non-difficult manner, in an easy manner. This helps shorten the time lag between academic discovery and practical application. When you look at the Indian educational system, for example, it is theory that just begins and ends with theory. The constant question we ask is, show me in your commerce, economics, accountancy textbooks, where is the practical application? People spend 5 years in college learning commerce, but at the end of the day, they have to start all over again when they get into the working life, learning from scratch, because that theory does not find practical applications. As somebody said, theory that cannot be applied is useless. So this was the challenge for Burton Malkiel. In 1973, I wrote A Random Walk Down Wall Street, which was largely devoted to an exposition of academic research on the stock market. The book has been successful and is now, then when he wrote this, it was in its 9th edition, now 11th edition. But the book is 500 pages long and filled with tables and charts. Many folks who need financial advice may not be willing to invest the time reading it. For that reason, Drake McFeely, my publisher, one day asked me an intriguing question. Do you think you could write a book of less than 200 pages in length that boils down the time-tested advice from Random Walk into an investment guide that would be completely accessible for a reader who knows nothing about the securities markets and who hates numbers. There are a lot of such people. People who hate numbers, hate mathematics, but they are willing to read if something is presented in a conversational and easy style. As a serial communicator, I was immediately taken up with the idea. The more I have studied securities markets and gained practical experience in investment management, the more I am convinced that there is a very simple step-by-step strategy that will allow individual investors to obtain better returns with less risk than even the sophisticated professionals achieve. In this long sentence, what Malkiel is saying is that investment is basically simple. You are not powerless. Today, more and more, we are dealing in a world of inequality. That is the main concern today for policymakers. It gets translated into changes in tax laws, into sometimes changes in social laws. But there is no doubt that one of the main problems facing the world today is inequality. We have something called inequality. It gets translated at the level of you and me when the budget is going to be announced on the 1st of February. We ask ourselves, is there going to be tax reimposed on capital gains on stocks? Now, why do we ask ourselves this question? What is the need for the government after maybe a decade and a half, almost 2 decades, of not having long-term capital gains on stocks? Why should the government now suddenly reimpose or even be planning on or considering toying with the option of such a reimposition of capital gains? The reason is this. If you study the wealthy and the poor, also the middle class to some extent, where do the wealthy invest? Where do the poor invest? You will find that the overwhelming majority of people who invest among the wealthy invest in stocks. The really poor, maybe a little bit in mutual funds, but that's it. But the real huge chunks of stocks worldwide in the major companies, controlling interests, substantial interests, heavy investments are by the wealthy. In order to reduce inequality, even a probably 1-month-old economic student will tell you that you have to take more money from the rich and distribute it wisely among the not rich. How do you do it? One of the simplest ways is taxation. If the rich are going to invest in stocks much more than the poor, and if stocks are going to have no capital gains tax on them, the rich are being given an avenue of tax-free investing. Therefore, if a capital gains tax is imposed here, the reasoning goes that you can get money which can be used to make an unequal situation equal. This is policy. I'm not going to comment on good, bad or ugly, because there are very good arguments on both sides. For example, the other side is that when somebody puts money in equity, rich or poor, we will forget for the time being. When somebody puts money in equity, you are putting money into something that is risky in the sense of a business venture. And therefore you have to get a higher reward. And capital put into the stock market is extremely productive, whereas taxes collected by the government are very often wasted. So there are so many arguments. We can argue the case endlessly, and at the end of the day, I'm sure the result will probably be something like a draw, because the arguments on both sides are very, very powerful. And it all depends on what our biases are. Are we right of center? Are we left of center? Are we extremely right of center? And so on. We'll not get into that. But all I'm trying to do here is, in the light of what Burton Malkiel is saying there, He's referring to one very important point that often escapes us. Inequality need not only be in terms of assets, wealth, money. There can be inequality in other fields. Inequality in education, inequality in knowledge, inequality in information and the access to information. And we use another term to describe that. Asymmetry. Things are not equal. I have much more knowledge. I can take advantage of the person who does not have knowledge, whether it's in computers or technology. That's why today you have a problem with your computer. If I have something here, how will I solve it? I look at this room. I don't have to look at, ask for your qualifications in repairing laptops or handling my software. I just have to look at who is the youngest person here and call them up. Okay? Because the younger the people are today, the greater the asymmetry they have when compared to people like us who are well into our 50s. So, asymmetry can take place in knowledge, information. This asymmetry very often misleads investors into believing that there is this huge, gigantic, powerful, knowledgeable, scientific mass of the financial services industry versus here I am alone, a very poor, humble, middle class investor with very limited resources. There's no way I can beat these guys. The only way I can beat them is to join them or to be part of them or to register with them as some kind of client and to be then dependent upon them. Malkiel is trying to say, no, not so. This is only something that is misleading, a concept that is misleading, deliberately put forth by the financial services industry to make you dependent upon them. This is where the financial services industry thrives. I know everything, you know nothing, therefore you have no choice but to be dependent upon me. Actually, it is not correct. So in the light of that, let's revisit this long sentence. What he's saying is, from his knowledge of the financial markets, which is more than 5 decades or maybe even 6 decades, from his experience in sitting on the board of directors of some of the largest investment firms in the world, Vanguard was not the only firm on whose board of directors he has served. What he says is, there is a very simple strategy which any investors can use to get, this is important, better returns with less risk than even the sophisticated financial professionals achieve. So if you can get better returns with less risk than even the sophisticated financial services people achieve, this disappears. When this disappears, you don't have to be dependent on them. The most successful investors are people who do not depend on financial professionals. They give orders to financial professionals. They only use them for accessing various markets. There's a huge difference here. If we are dependent, we are not likely to be successful in our investing. Malkiel goes on to say, the result is this book, designed to be comprehensive and practical, easily readable and completely accessible even to the lay reader, the only investment guide you will ever need. And it's true when we look at the 10 rules for financial success. Now, Malkiel went beyond that. He collaborated with another friend of his, another professor called Charles Ellis, who is also a brilliant writer. Collaborating with Charles Ellis, another superb writer, Malkiel published The Elements of Investing in 2010, an even simpler book than his earlier simpler version. The second edition of this book was released in 2013. This is recommended entry-level reading for all students of investing and for novice investors. Malkiel stopped the other book in 2002, but 2010 and 2013, you have got, if this book was 175 pages, the Elements of Investing is probably something like 140 or 145 pages. So this is a beautiful book to start with. In fact, for our US clients, you can also note this down for US clients, or make a mental note of it at least. If somebody is in the US, they are freshers there, they have just started working there, 2 books you can recommend. The first book is this very simple 140 or 150 page book called The Elements of Investing. Only thing is, make sure that when you recommend this book, you ask them to buy the 2013 edition, which is the latest edition. So this is the first book, The Elements of Investing. The second book that I would recommend is a book called Personal Finance for Dummies by Eric Tyson. If somebody is buying this in the United States, 8th revised edition, 2016. So you can actually help people who are there just by buying 2 books. They don't have to rely on financial professionals. Both these books are pretty simple to read, and they are most effective when somebody has, let's say, got educated in the US and then worked in the US for about 6 months to a year. So when you work in the US for about 6 months to a year, you're working, earning money, paying taxes, doing some savings. You slowly get to know what the situation is there. That is when you need some very sound advice about how to plan your investments, how to save the maximum possible tax, how to deal with retirement needs, when and how to buy a house. Even if someday you want to move from employment to entrepreneurship, Personal Finance for Dummies has a beautiful chapter on entrepreneurship in the US. And if I'm not mistaken, Eric Tyson has written a separate book called Entrepreneurship for Dummies. But this is a superb starting point, very general and comprehensive starting point. Coming back to Malkiel, most academics are far removed from reality. Burton Malkiel is someone who has seen both academics and practical investment. Malkiel started his career in a Wall Street brokerage as an analyst. This gave him a deep insight into the various goings-on both in the stock market as well as brokerage houses.